We quickly move on to our next panel. It's LP's views and expectations in the aftermath of COVID-19. And this session will discuss the LP's perspective on the changing business environment and how it has affected the portfolio allocations, manager selections, and the risk and return expectations. Before I introduce our speakers and moderator, our wonderful delegates who are joining in, please feel free to send in your questions. The panel will be doing a short Q&A at the end, so send in your questions while the session is on, and I'm sure the speakers will be happy to answer your queries. Our speakers for this session are Sunil Mishra, Partner, Primary Investments, Adams Street Partners; Anand Unnikrishnan, Managing Partner, Fund of Funds, National Investment and Infrastructure Fund; Takahiro Kato, Head of Global Fund Investment, DBJ Asset Management; Vishwanathan Parameshwaram Param, Head of Investments Asia and EM, Co-Head Schroeder Advec; Menno Dirks, MD Private Equity Sarona Asset Management, and our moderator, Padmanabh Paddy Sinha, who's a ex-chairperson of IVCA. Over to you, gentlemen.
Good evening. Can you hear us? I think it looks like we are all on screen. No glitches so far. So, while the pandemic has upended our world, I think there are silver linings and small mercies. And one of them is that we have 5 LPs from different parts of the world in for this session today. So it's a great privilege to have 5 different LPs going east to west. We have Kato-san from Tokyo. We've got Sunil in Singapore, Anand here in Mumbai, and then we've got Param in Zurich and Menno in Amsterdam. So thank you to all of you. Maybe I can kick off by requesting all of you to just do a very brief introduction about your firms in perhaps half a minute each, and then we can move on with the panel discussion. So we can perhaps follow the same order, east to west, to avoid confusion on the panel with the lag. So Kato-san, maybe you can start off.
Hi. Good evening and good morning, everybody. My name is Takahiro Kato, DBJ Asset Management. I'm based in Tokyo and investing private equity and infrastructure universe. We do investment, roughly speaking, 30 to 40 fund investment in a year. And also, we started the investment in the private equity field since 2002. So roughly speaking, the 18 years experience we have in the private equity field. Not only the domestic Japanese Japanese GPs, but also we invest globally, US market, European market, and also, of course, the Pan-Asian market, including the Indian market. Thank you very much.
Thank you. Sunil, over to you.
No, thanks, Paddy. So good day to all. My name is Sunil Mishra. I'm a partner with Adams Street Partners. Adams Street is a global private market investor. We've been in this business for over 45 years, and we manage close to $40 billion within private equity, venture capital, and private debt. So covered the whole spectrum of that. I'm part of the primary funds team, which basically invests in funds across the world. I'm part of the Singapore office, which basically covers Asia. My responsibilities include covering India and Southeast Asia, Australia, Korea, Japan, so most of the ex-China markets. We have been investing in India for over 15 years and been active in the market for over 20 years. We have sizable exposure to the market across the spectrum, and we're very, very happy to be part of this panel and lovely to talk to you.
Thank you. Anand, that's you next, I think.
Thanks, Paddy. So I'm Anand Unnikrishnan. I'm the managing partner for the Fund of Funds at the National Investment and Infrastructure Fund, NIF. NIS, for those of you who are unfamiliar, is a relatively new institution. We were formed about 3.5 years ago, anchored by the government of India and now investor owned. And what we do is we manage we're essentially a fund manager which manages 3 different funds. So we manage an infrastructure fund, we manage a fund of funds, and we manage a strategic opportunities fund. As I said, I look after the fund of funds. We have we launched about 2.5 years ago. We have to date invested into 4 funds. We have the flexibility to invest across sectors, into multi-sector funds and across asset classes. So to date, we've invested into areas such as green energy, affordable housing, healthcare, as well as a multi-sector fund. That's what we've done so far. We have the ability to write large checks and go in as anchors. So our largest commitment is about 170 million into the green energy fund that we've backed. Our smallest is about $18 million into a healthcare fund, and we're also exploring new areas such as venture capital now.
I think we have Param next.
Hello, everyone. My name is Param. I represent Schroders. Schroders is a listed company on the FTSE 100. On the private asset side, so on private equity, we invest in private equity globally across sectors, and whether that be any flavor in funds and companies. In India, we've been investing for more than 15 years. And post 2010, India is a key market for us, even on the co-investment side as well.
Okay, thank you. And Menno, to wrap up, please.
Yeah, thank you, Patty. Actually, I've personally started investing in emerging markets 15 years ago, and I started in India, so that's it was really a great start to my career in the emerging markets investing. Now I'm at Sirona for the last 7 years, responsible for our global private equity program. We invest across emerging markets only in Latin America, Africa, Eastern Europe, and Asia. And well, of course, investing in India always keeps a special place in my heart because that's where I started my career.
Super. That's great to hear. So thank you, all of you. So before we get into the deeper discussions on the post-COVID world, maybe I can start off with a sort of a question in a lighter vein, one with which I have a vested interest as well. Typically GPs need to meet you several times at least, and particularly for the first time fund, maybe 10, 12 times. So in the post-pandemic world, do you think it will be an acceptable norm for GPs to meet you partially virtually as well? So supposing they're meeting you 10 times successfully, do you think some of those meetings could actually be virtual on an ongoing basis? Or you think this is a business which requires the touch and feel such that each meeting would need to be a physical one like it was in the past? Any takers for that? Just to start off.
Happy to have first take at that one. It's a very tough question, and we have not fully made up our mind on that one as well. I think it also has perhaps a bit to do with the gray hairs here. That I'm still a believer of the old-fashioned meeting people and seeing each other and look each other in the eyes and spending time together. So for first-time teams or first-time relations for us, I think that we're not there yet to do that completely through Zoom. If you ask me the question 6 months from now, let's see what, and if we're still in a similar situation, it could well be that we have changed that. But fortunately, over a long period, we have been interacting with so many GPs over the past years, and all the GPs we invested with, but also the GPs that we didn't invest with. So I think we still have a very large pool of GPs there where we would feel comfortable with doing our due diligence through Zoom.
Sure. Just to clarify, obviously, I would expect at least some of the meetings would be physical meetings, but I was wondering whether virtual meetings would, in a business like private equity and venture capital, where obviously the nature of the relationship is a very serious one, a long-term one, whether to some extent virtual meetings you think could come in post-pandemic. But that's very useful.
I think it will be much more. Yes, I think that will stay.
That's right.
Absolutely. Yeah.
And Patty, if I can go next and add in a little bit of sort of my perspective, right? Look, I think we would be actually okay to continue doing business by meeting people virtually, right? To be honest, I think a lot of it, what the last 6 months have shown is that a lot of the work that we thought we had to be absolutely physically present for, you can do online, right? And that applies to across industries and our own. So I think we'll feel quite comfortable in meeting GPs virtually, in having probably more meetings. There is sort of a degree of formality which you would otherwise not always have. I mean, we couldn't go out for a drink with you, but but I think what we do expect is that we would continue sort of backing managers, even though the environment is a little bit tough.
Sure. Okay, let's move on. Obviously, private equity, venture capital are very long-term animals by their nature, and 2020, as we all know, has upended, but we need to look beyond it and see what the consequences and implications are. So I'll broadly split it into three segments. The first is on your existing exposure, portfolio, or relationships. The second on the opportunity for new stuff, and the third on issues of special interest. So going first into what is your existing portfolio and exposure, and what your read through is first globally, and then we'll come to India on what are the implications for returns on the existing portfolio. I mean, I would assume that there's, again, it's an aggregate view that I'm seeking or requesting for. Obviously, there'll be some companies or maybe a large part of the portfolio where underlying portfolio through your GPs, where it could be more like a V-shaped recovery, as they say, 2-3 quarters of a reduction in financials, but eventually coming back to where it was or could have been. There could be some which may be benefiting from the disruption and could actually post recovery have an accelerated path. And there could be some where there is possibly impairment or more like an L-shaped recovery, as they say. So, since all of you sit across portfolios and therefore see this emerging, and it's still a dynamic situation across your portfolios, what is your sense right now of what does it mean for your existing portfolio exposures? Or even generally as for for LP returns versus where it would have been pre-COVID on existing exposure.
I can maybe take a stab at that.
Go ahead,
Sure,
Parag.
I think Param and then
Hey.
Sunil can. Yeah.
Okay. So very quickly, right? So I think for us, private equity has proven its resilience during the crisis, and you see that compared to markets. So you see that in Q1 and in Q2. So that's a big win for private equity. Second, what we've seen is that the buyout investment activity has slowed down, but the venture industry remains unaffected. Third, I think it's more forward-looking, focused on stress testing, and I think we'll come back. But I think also in terms of sector exposure, to your point, a major portion of our investments have been in technology and healthcare, even prior to COVID, of course, and they've done exceedingly well. And then for COVID alone, I think it's been different for everyone. China, Brazil, or India, it's been different for everyone. So I think returns have been by a year.
Got it. Sunil, you were saying something as well?
No. I think first part was not very dissimilar. So my view is that we are a long-term patient asset class. Short-term volatility actually is something that we can take advantage of. In terms of recovery, whatever alphabet what you want to use, but clearly a new alphabet, new recovery called K-shaped recovery is gaining a lot of ground, where there is obvious winners and some obvious people who are not benefiting as much. Um, and interestingly, it just so happens that over the last few years, actually over the last 5 to 10 years, our portfolio, given what we've been looking at, and everybody kind of was waiting for a crisis. Nobody thought it would be a health crisis. Everybody was kind of waiting for an economic crisis, and people were trying to be as safe as possible. We just saw we had ended up with a higher exposure in healthcare and technology, and those two sectors have been quite resilient. Actually, disproportionately supported by equity markets as well. So some of that might normalize. But what I would say that there'll be some we were also enjoying. Sorry, we were also enjoying a lot of healthy distribution pace. So there was a lot going on across sectors, across industries. Some of that might bifurcate, so we will see some bifurcation and dispersion in return. So on an overall basis, it might be slightly slower in terms of distribution pace. So we'll go back to what 08, 09 was, where there were a lot of distributions, a lot of capital calls and very few distributions, and there was slightly longer holding period, which might prolong exits and reduce IRRs. But hopefully, at the back end of it, we'll be able to make up with some of these businesses who are compounding at a much better pace. The good thing here is that interest rates remain at record low, and there is no other way to find greater returns. So, alternatives kind of remain of higher interest to a lot of institutions and families.
Yeah. Rato-san, if I may ask you, Japan is a deep source of capital for private equity venture capital. So what is your sense of, I think the read so far was that K-shaped recovery, some sectors actually benefiting, some lagging, but DPI will probably happen, but with a lag on existing portfolio. Is your read somewhat similar, or do you have any different perspectives to add?
I think the general perception is same as the other regions like USA or India or Europe, I suppose. Still, in our case, in our portfolio, we didn't change our portfolio at all. So still keep the same existing portfolios and still keeping the same pace of the investment. So as everybody mentioned, so the private equity is a long-term period business. So we need to keep the long-term relationship and continuous investment. That is very important for us. So, and also the two things I found out during these 9 months, starting from the January. One is between the Q1 and the Q2, obviously NAV changed dramatically, but end of the Q1, many of the fund showed the NAV, total amount of NAV has decreased, but end of the Q2, many funds returned the NAV dramatically. So still a little bit early to think about the impact of the COVID. I think so just end of Q1 and the Q2 is many impact come from the listed market. So I think the actual impact of the COVID would come to the next few quarters, I think. Still the COVID is continuing. So gradually the impact to the economies will happen, and also it will impact the private equity field. In that sense, we need to keep eye open and look the private equity market. So it's a little bit early to consider, for example, so sell down in a secondary market or invest to the particular industry. So, and the second thing is importance of the diversification. So we have invested some fund of funds, and the returns came from the fund of funds is slightly have the time lag. So currently still a few fund of funds generate returns, but I suppose the returns generated to the so underlying funds might be the last year, and also the underlying assets generate returns maybe the 1.5 years ago. I'm not sure. So in that sense, so still diversification to the industry or type of the investment, that is very important. We obviously, in our case, so this year in 2020, the total dividends obviously decreased compared to the last year, but the level of the decrease is slightly different from the actual sort of impact of the COVID itself.
Thank you. Thank you. So moving into India.
Can I add? Sure.
Yes,
so
sure,
if I can add something to it, if you're okay. So I also think that look, IRR may be a bit lower, and that, yes, we do see in general some delays in the DPI. end of Q1, we were very concerned about liquidity concerns in our portfolio, and that did not play out. We were very happy to see that it didn't play out, and this is something I think this is for emerging markets in general, and also for India specifically, or the case why that happened. And I think that's two main reasons. Is that in emerging markets, fund managers and companies are used to deal with shocks. There's always shocks happening. And in India, there is GST, demonetization, and Sunil already mentioned resilience and how important that is, and that we also have been focused very much on that. And I think that this has been very helpful for many fund managers and companies in this crisis as well. And let's not forget, in emerging markets and in India, private equity is not about levering up companies as much as possible. And so leverage levels are typically quite decent. And also there, maybe the MBFC crisis with ILFS has actually helped a bit there, that at least there was quite a lot of focus on deleveraging and stability in companies. And therefore, I'm quite hopeful on continued resilience in the coming quarters as well.
Well, that's actually a useful point, Menno, and I think fair point that we weathered a few storms here and a few scars on the back, so it makes it more resilient relatively. Thank you. So, in fact, yeah, it's a good segue into India, because I was zooming into India from the global perspective. So, I mean, just to sum up briefly on India macro, obviously we had a quarter where the GDP contraction was one of the highest, but that's because that was natural, given the lockdown in India was much more severe than other places. But lately, we seem to have a lot of the indicators showing a pretty good recovery now. Whether it's playing a catch up or sustained, we'll figure out. But whether it is manufacturing PMI, GST collections, auto sales, electricity consumption, everything seems to be coming back to pre-COVID levels. So, and of course, as was previously mentioned in one of the prior panels, I think the government has pushed through some very significant reforms on labor and agriculture, and put in some incentives for manufacturing to help India integrate into the global supply chain, benefiting from the current macro shifts and people diversifying from China. So, I mean, one read of this would be that the investable industries in India could broaden. Of course, tech and healthcare have always been seen to be attractive in the Indian context, but it could broaden to many other sectors. But also the related question before we even go to the opportunity set was that when you look at the impact on your GP relationships in India and the underlying portfolio, is it substantially different from what you see from elsewhere in the world, or is it of a similar nature? I think Menno already referred to one part about the resilience, but anything else you guys would like to chip in with on that? Anything specific to India? First. Yeah, sure, Sunil, please.
I can start first. So, to some of the other markets that we invest in, very little or negligible buyout, and sometimes in situations like this, liquidity can, or lack of liquidity can actually just completely kill the business. So in that sense, growth capital definitely is better suited to go through some of these crises. And we are assuming that, businesses which are under stewardship of private equity investors are, better capitalized, better run, and, have better ability to, kind of lean on to creditors or to other sources of financing to keep them afloat. So hopefully we are with stronger businesses to start with, which can actually weather some of these storms. So I would say, compared to the buyout world, where some of these issues can show up very dramatically, very very quickly. India's generally the investments that we had were a lot more resilient. On the venture side, there is, crisis never tells before arriving. That's why it's called crisis. There are people who are in the midst of fundraising, midst of IPO, midst of exit. And, if those processes were cut to fine, for a variety of reasons, so maximizing your valuation or maximizing your last round, something like that, those situations can be tricky. But, that is nothing unique to India. I think it can happen to any part of the world. So when this crisis first happened, I think that was the first advice we gave to all our GPs in India, is that, the way this is going to unfold is that, liquidity will be the king here. So the most important thing is to shore up liquidity avenues as quickly as possible. And, for venture guys, if there is a term sheet, close it quickly. Do not try to haggle too much, because, you never know, it's going to last 6 months, 9 months, 12 months.
Super. That's useful. Anything else? Any LPs would like to add to that on India specific REITs?
No, I think one point I'd mention here is transparency, right? So I think Indian GPs have stepped up to the game. They're getting more transparent with what's happening in the portfolio companies and being a bit more proactive. So that's definitely a positive.
Thank you. Thanks.
I just want to mention currency as well. Compared to other emerging markets, our investors come mostly from US and Europe. Indian rupee has held up quite well compared to Latin America and also other emerging markets. So that's quite helpful for us.
Yeah,
Okay,
I think
so
I have
then-
one comment. So,
Yeah,
sorry, I have one comment. So it's not specifically for Indian GP, but reporting is very important for us when we select a fund. Not only the return by the fund, but also the attitude for the reporting to the investors is quite important for us. So, very transparent and detailed reporting to the investors are quite important. So, obviously, there are many things happen in the underlying assets, but that's true, and we accept the result. Just we bet our money to the GP. So, in that sense, the transparent reporting is very important.
Fully agree.
So moving into the next segment of the discussion, which is the opportunity post COVID in terms of broadening your relationships or re-upping or India specifically versus other markets you're investing into. So I don't know if any of you saw the Preqin data, which was just presented at the beginning of this. So it did show, as was to be expected, a big drop off in fundraising for India for both PE and VC. So hopefully some of that means pent up demand going forward. In any case, India, because of all the crises it's seen in the past, seen some consolidation in the GP segment as well. So you have a few, apart from the global funds, which typically do larger deals, you have a few larger Indian funds, India-focused funds, and then you have obviously a very long tail of funds with domestic money primarily. And then the mid-market perhaps has fewer players now than it used to, given fundraising for India has been tough, etc. So there are segments. Similarly, I'm sure for the VC landscape also, there could be some analogies, though less so than probably the PE landscape in terms of consolidation. But so what does all this mean moving forward? Where do you see the opportunity in India post-COVID? We discussed earlier some sectors are anyway beneficiary, and also some formalization that's been happening in India. Therefore, PE investable companies have been gaining. So really would like to ask each of you on what is the opportunity you see moving forward. Anand, do you want to kick off? Since you have not spoken.
Yeah, I can kick off, Paddy. So look, in terms of new funds and new relationships and what we'll commit to in I guess at this point, right? I think the way we think about it is we are a 15-year fund of funds. Okay, so if we just put the hat on as a fund of funds manager, we have got a 15-year life. We are at a point in time today where there's been a dip in the Indian economy. There's a dip in the business activity. Does anything fundamentally change for the next 15 years? I don't think so. The whole India is that consumption will grow, incomes will grow, and there will be consequential economic growth, and some sectors will benefit more than others, right? And we're talking about, for our portfolio, we're talking about maybe 100, 150 companies that we'll have through the portfolio that we invest in the fund. And when you think about a 15-year time frame, we've always talked about $10 to $12 trillion economy or that period of time. Frankly, whether it's 12 years or 13 years or 14 years, if it takes an extra couple of years to get to that kind of size and scale, it doesn't really matter that much. So the way I would think about it is we would continue backing managers, and in some sense, when I listen to some of the other panelists, we've been relatively lucky because we've not been impacted that much by COVID in terms of the portfolio. It's a new portfolio, it's a young portfolio. Our managers are actually buying rather than selling now, right? So frankly, I think it's, for me, when I talk to the managers we've backed, the question is, yes, there is a crisis, but is there an opportunity within the crisis? And I think 5 years from now, we'll probably be looking back at our portfolio and saying which are the managers that actually took advantage of this time. So in terms of the long-term prospects, they remain the same. I don't think we're sort of wavering on that. In terms of manager evaluation and how we think about new GP relationships, look, I think an important part of our evaluation going forward will be how have the GPs responded to this crisis, right? So there are obviously controllable factors and there are uncontrollable factors. So the uncontrollable factors are, I guess, everyone's impacted. I think what we would be looking at is what were the controllable factors, what were the measures, what are the mitigants that the GP actually put in place to try and protect their portfolio first, and then see how they can realize the maximum amount of value. The one negative about the Indian private equity industry has always been that exits have taken too long. So is this going to sort of add to that? Are some exits going to take longer than expected? Absolutely. But I think GPs who want to have a long-term sustainable business want to keep raising funds. I actually agree with one of the comments made. Right? An opportunity. I think Sunil said that if there's an opportunity to accept a valuation which may not be ideal, but it's something that still works. Differentiate one GP from the other, right? Are you holding on for too long in the hope that there will be a whatever letter VWK shape recovery, or are you saying that now's the time to generate some liquidity? Can I be opportunistic? That's how we would evaluate GPs.
Got it. Kato-san, since you have relatively few relationships in India, I think, how would you look at expanding that in India? And a related question is, in fact, I have some questions coming in. So, for the panel is obviously the thresholds for first-time managers are high, but what can a first-time manager do to get you across the line?
Yeah, in our case, we don't have any local office in India, so all the meetings or due diligence done from Tokyo. So, in that sense, so we need a little bit absolute size of the fund. Firstly, so at least 1 billion or 1.5 might be the minimum size of the fund. So in terms of the ticket size, we do the 10 to 40 million. So in that sense, we need a relatively large scale. So, but in case of the Indian market, so there are a few large scale managers, and obviously we have the relationships, but the mid market is quite empty. So so in the Indian market, you need to blow up the mid-market to a relatively appropriate size. So actually, this is quite similar to the Japanese domestic private equity market. So we don't have, in a domestic case, we do investment to the relatively small market. It's a sort of the country bias. So we can do, but so situation is quite similar. So I'm not sure why the also in the Japanese market is there are a lot of small managers and there are not so appropriate size of the managers. But in the I suppose also it's so for example, in the U.S. market, it's a quite the origin of the private equity field. So quite easily, so many fund managers grows. So because many investors are quite easy to inject some money to the all the level of the industry. So, but in case of the Japan or India, so I suppose something the sort of the helps or guidance from the government or something third parties. We need something the flavor of the support by the third parties, how to help the industry, how to grow the industry. So this kind of the attitude, in my sense, for example, if I see the Japanese market, I suppose I need something like that. So I'm not sure in the Indian market. So, but if in terms of the growing the mid market, we need something the third party's assistance.
Understand. Mano, would you have any thoughts around increasing relationships in India, as well as I think the question we had on first and second time managers?
Sure. Yeah. So let me. So on the mid market, we are only mid market focused. We are a smaller firm. We focus on funds typically between $100-500 million, and so we've been following that space for a long time in India. And I think the development is healthy that we have seen over the last few years in that sense. 10 years ago, I think we had more than 200 funds in our pipeline in the mid market space in India, and a lot of them don't exist anymore. And yeah, look, I think some of them started enthusiastically, but were not able to deliver. Let's say it like that. And I think the ones remaining in the space, there's quite a couple of strong ones out there. That I think are also performing and also still stay in the mid market space. So I think it's quite healthy space at the moment, and quite excited about it to make selections there. And then going on your question on first time funds, it's tough. Look, we are a fund of fund. I think first time fund managers, I would say, speak with the DFIs. They still. Although they're also shifting their focus a bit, but there's still many of them have it as their in their focus to support first-time fund managers, and they want to be part of the first close. From our end, as a fund of fund investor, we do first-time funds. We have done them. We'll continue to look at them, but then typically we come in at a final close. We want to say 2 deals being closed. And in the end, yeah, you're competing with a couple of those maybe mid-market managers who do have some experience in the market and have some track record, and so that can be a tough one. But if you're in a certain space, in a niche space, and you have a team together that really has proven experience, I mean, typically a first-time fund is not done by 2 people just started into private equity investing. It's also about the background of those people, and we can carefully look at that, and then actually we can take a judgment there. We are not saying. Some fund of fund managers say no first-time fund managers for us. We're not saying that. We can look at them, and we will actively look at those as well.
Any other comments from the panel?
Only thing I'll add is that first time fund is never an easy fund, okay, and not being able to meet is never not going to make it easier. I get this question a lot, so I think what I think is I think people should use this time very wisely. The good thing is that LPs are also not traveling, so they have more time. So if you have high quality intellectual content to share, insights about the market, something that which we probably are missing because we are also not able to visit, right? We are not able to travel. If any of those insights can be delivered, whether it's in a email format, white paper format, even a quick webinar, don't need to be 3 hours. That's the right time to kind of build your intellectual rapport with those people. It's sooner or later the markets will open. And we are in the business of putting money to work. We're going to find these smart people with whom we have been impressed over the past few weeks, few months, whatever it is.
Got it. Param, did you want to add something? Sorry, you want to add something, Param? I thought you were.
No, I think I would echo what they said. I think I would stay away from theme-based investing because I feel theme might be short-lived. So be careful about your chosen strategy.
Sure. Right. Okay. Then moving on to maybe a little bit on the VC space in India as well, particularly since a couple of you are quite active there. Obviously, tech in India has seen rising growth, interest, and valuations as well, and there have been a few other factors in play, including the mobile data consumption in India is one of the highest in the world, if not the highest, and you've had a spree of fundraising by Geo, all that should add to the ecosystem eventually. So how are you looking at the VC industry in India specifically post the COVID related events and all that's occurred over the course of the year? I think Param and Sunil, you're more active on the VC side, right?
Yeah.
So perhaps you could address that.
I can give a stab at it. So I think so the way I look at it is Geo has laid down the highway, and the entrepreneurs can now have their Ferraris and startups and go as fast as they can. But I think VC, it's the best time for VC today in the country. Immense value creation possible. Um, uh, Basically driven by two things, I think. So one is the industry has matured. Of course, it has moved from pure marketing-driven business models to profitability and risk-driven. I think that's the main change for venture, and that bodes well for the VC ecosystem. And secondly, I think venture is now addressing inefficiency that was originally meant for private equity. And now I think that is also being pushed out. It's been the best time with more than 20 unicorns in the country.
Okay. Anything from your side, Sunil?
So two things, one is, venture and other is tech. Okay. So our view is that, tech is omnipresent now, means it's going to be part of every business, every industry, and we'll just see an accelerated usage of that. So, we'll see it, industry 2.0, retail 3.0, whatever you want to call that. On the VC side of things, clearly once with the level of computer and this smartphone adoption, we kind of knew that at some stage a whole lot of usage is going to come through. The question was, what would drive significant adoption and adoption in a way where people are ready to at least pay for something. It's not that people don't want to pay. It's paying capacity is limited. We're still at 2,000 per capita income economy. So there are certain strings limit here, and that's an average here. But what this COVID has done, similarly, if you go back to SARS, SARS did that to China. So we think that this COVID might have done that to India as well, where it would have accelerated adoption of technology for for very traditional businesses and industries and business folks. So that definitely opens up an opportunity for people to be able to monetize. I think that is what the industry was doing. I think we have seen great great boom in startups over the last 5 years. Great acceleration in terms of people being able to build quality product. Some of them actually can go outside of India as well and successfully operate. But to be able to get good monetization, because that's what is going to get valued now. Unit economics is going to become even more important going forward from here, and more investors are going to ask for that. And as we see the merging of the lines between venture and growth guys, growth guys look at some of those metrics and they have interest in taking on this, patent and finishing the relay race, which I think is probably the right way, given we still don't have a local tech IPO market or massive tech acquirers in India. So I think the participation by traditional growth capital players in some of these companies would be crucial, and hence those business models need to show uh, solid monetization. But I think this should help. So I think we will see accelerated pace and hopefully good scaling with good profitability built in.
Got it. I don't know how we're doing on time, but a quick couple of questions I do want to cover, and one question from the audience as well. So one was, Sunil, while we're with you, I noticed you're on the ESG committee for Adam Street, and that's where I wanted to understand how you're looking at ESG being integrated into PE and VC investing. Is it part of a mainstream, or is it more focused around funds which are really impact funds or responsible investing funds? Or is the current thinking, because we do read about a lot about ESG for public markets, but as far as alternative markets go, is it my specific question, and anything else you would like to add? Is it more integration into the mainstream, or is it specific funds with an ESG bias that you think work better?
Yeah, so maybe thinking of ESG as an impact as something outside mainstream private equity. I think that is thinking a few years old now. I think ESG is kind of pretty mainstream now, and all the large investors actually started by mostly European investors, but adopted globally by a lot of very large pension funds and investors. I think most people want to ensure that certain basic things are adopted, and every and actually we should walk before we run. So that's how we are thinking about it. First we need to be compliant. We don't want that uh, we want to be good owners of assets. Be in compliance with regular laws. Have good governance practices. Of course, in private equity, governance was probably very important from a commercial point of view as well, but environmental and social, and say gender and diversity is probably one of the easiest to take an example of, and we are seeing a lot of effort being made by private equity firms and companies in being able to promote that. But it is getting pretty mainstream now. We at Adam Street also are kind of have completely adopted it across all our diligence processes. So when we are talking to GP, we are actually checking them across several things. We haven't become a development institution, but what we want to do is we want to ensure that there is good positive compliance, and if there are serious issues, we might have to relook at our decision as well. Something that 10, 15 years ago was not that. I would say venture in general is firms are leaner, reporting processes are slightly leaner, so probably lighter, and of course industries that they face with also are less susceptible to that. Never say no, but less susceptible to that. But so it's higher priority in buyout and growth, where there is more real economy friction that we need to have higher sensitivity.
And Menno, would you, being a European business, would you have a similar approach? Is it more around checking the boxes, or do you actually, and particularly since you look at mid-market private equity, or do you also look at firms needing to achieve some ESG return sometimes, or is it more about compliance
Yeah,
with
yeah, no,
ESG?
for us, ESG and impact is really integrated in what we do. But first, we need to achieve high returns for our investors as well. And also personally, before I joined Serona, I was with FMO and PGGM, who are also very much focused on ESG and impact. So I've always been focused on that, and I fully agree with Sunil. Over the past 15 years, I've seen a big shift, and I think it's really part of normal business of almost every GP I interact with in India. And I even dare to say that in emerging markets and in India also, and I think to the credit of the development finance institutions such as IVCA, DG, and FMO also, they are ahead of Europe and the US. In Europe and US, it only became a hot topic maybe 5 years ago or so, and I think in India it's much more integrated, much longer time ago already, and they're catching them up rapidly in Europe and US as well. But
Got it.
Patty,
Uh,
if I could add a comment there, Patty. So look, ESG, yeah, it's Anand here. If I could add a comment, ESG for us is mainstream, as Menu and Sunil mentioned as well. And look, we've been fortunate in the early stages of our institutions. We've had backing from AIIB and ADB, and these two institutions, as you know, they've helped us sort of raise the bar on ESG. What we want to do is to sort of raise the bar for Indian managers, and for us, it just makes business sense, right? So you've got to manage your risks. Yeah, environmental and social is just one of the risks that impact your business, and you've got to be responsible. So that for us is mainstream. What we are actually willing to do is some of the managers we back, we recognize that they may not have the right ask them to adopt. We are happy to hold the manager's hands. We are happy to sort of invest time and effort and money to make sure that we are helping them raise the bar. But that for us is critical. And the way we think about it is it's not just when you're looking at a manager, it's not just what financial performance or what financial returns has been delivered. It's also how those performance numbers have been delivered. So for us, it's the what and the how, and ESG factors into the how side of things.
Got it. Great. So, one question from the audience was on, and perhaps, I mean, some of it has been covered on 2, 3 key criteria for manager selection. I think some of you spoke about prior experience, even if individually you spoke about, discussing on webinar strategy and how differentiated the firm is. But anything you'd like to add, since we specifically have a question, which is what are your two key criterion for manager selection? So, and apart from the obvious ones, track record, I guess those our audience will know. But anything you'd like to point out in particular?
I think many of them have been touched, but I think and a very important ingredient is the team, because we are investing with the team, and we are actually investing what we call a blind pool risk. It's a 12 to 14-year journey. Uh, uh, this is a very very long journey. So last thing we want is the team falls off between somewhere along the way. So I think a shared history, a shared working history, and if the shared working history is with some level of economic sharing, I think that is what we like to see, so that people can see eye to eye in good times and bad times. And sometimes there is no other option but to see them for a while. It's a bit like the tango that you got to do, slow tango, before you start doing the jazz.
That's nicely put.
Yes, so Patty, I would echo that. I think we would like to see risks and rewards shared equitably within the team, or shared fairly within the team. Let's call it that, right? So not equal but fair. And I think what we'd want to see is when we're backing a manager, we would want the ability to see if we could back the manager for their second fund and the third fund, and in the future. What that means is what happens to the team as the senior sort of person decides to hang up their boots, and is there a proper succession planning in place? All of those are important considerations for us, which I think you know my general sort of opinion is that that's not very well thought through when we speak to managers in the Indian market.
Right. Alan, would you like to add anything? Anything you look at in terms of key criteria?
I think we've covered everything. What I would add is I love to see theory put into practice. So if you're working on a live deal, handhold your prospects through that, so that they understand your thinking and how you're working and how across. So you would definitely have some sponsor capital. I'd say put that to best use rather than coming to LPs and saying we've already done our first deal. So I'd say even before that, get LPs with your prospects.
Sorry, you broke up on that. You said get LPs in alongside, is it, on your deal?
Get outside your live deals.
Oh, got it. Kato-san, you mentioned earlier that you're typically a big investor, but of course, in Indian context, as you rightly said, there are no funds above $1 billion, and you said there you would look at the middle segment, etc., where there's a gap. But anything specific you would look for in terms of criterion, apart from some of the things which have already been covered?
Yeah, that's a very good question. If I know the right answer, maybe I will raise my fund of funds. Anyway, so team is very important, firstly, and the second is a track record. So in that sense, the first fund is quite difficult to analyze. So the third point is a reasonable and stable strategy, no drift. That is the 3 points in my case. Yeah.
Wonderful. Mano, anything you want to add? Or?
Yeah, maybe just to add, the long-term relation is so critical for us. You're going to be there 10 plus 1 plus 1, and you can add a couple of ones probably. And we all spend a lot of time and money on the legal docs, but soon enough you will run into a problem that's not covered well in your LPA or side letter. And then you better make sure you're dealing with a team that you can solve it with, and that you need to think of in advance, that you can see eye to eye, as has been said before. And also want to point out how important we find the relations between the GP and the portfolio companies. We always pay close attention to that, how well they interact with the companies, and also there they will have to deal with issues in some way or the other.
Sure. So I'll end, since we're almost out of time, with a lighter question again, as we started off. So since one of the overarching themes driving equity markets up has been low yields and low discount rates, and that's what's being used to justify big tech, etc., going forward, that future cash flows are discounted at a low rate. Does that mean that realistically the LP expectations, and I'm saying this tongue-in-cheek, but worth for debate. In any case, LP expectations in private equity and venture capital come off a bit from, let's say, whatever the standard template $20 net returns, etc. are. Is that realistic, or you still like to aspire for that and see what best can be achieved? So it's a headline question around net return expectations.
I haven't received that memo, so I think it's still at 20%.
Okay.
Sorry.
In the Japanese market or European market, the low interest rate continues over the past few years, but good managers still generated the appropriate return. So we expect the same level of the returns continuously.
Understand.
I would say the same. Yes, I expect the same level of returns, but I think investors take in their mind some discounts to that, and then hopefully they come somewhere, let's say between 10 and 20% net in their minds. That's what I think.
Yeah. No, I guess the returns obviously should be as good as they can. The question would be to be realistic on a risk return spectrum. You also want to manage it with reasonable levels of embedded risk. So in your minds, realistically, 20% net dollar return can still be managed with, and of course, it will vary from venture and private equity, etc. Can be managed with reasonable conservatism in the portfolio in the current context, I guess. Good. No, thank you, everybody, for this very useful and frank discussion and lots of good inputs. And I know some of these questions are difficult to answer on what it takes to be successful in fundraising. So, but I think some of you put it quite effectively, whatever feedback was there. So thank you so much for your time at various points of day for the geographies you're in. It was a wonderful discussion. Thank you.